Bitcoin ETFs are now available in retirement accounts. Fidelity, Schwab, and Vanguard all offer them. The question: should you add crypto to your retirement portfolio? I ran this question through 3 different AI models. Here's the synthesized answer, with the honest caveats. This is not retirement advice. For your specific situation, consult a financial advisor. But the framework AI provides for thinking about this decision is genuinely valuable. When considering an asset as novel as cryptocurrency for a portfolio as important as your retirement, the first and most crucial element to understand is time. The fundamental case for crypto in a retirement strategy hinges on a long-time horizon, which has historically served to smooth out the asset's well-known volatility. For a long-term investor, the daily or even monthly price swings become less of a concern, fading into the background of a much larger trend. The power of time allows market cycles to play out, giving an investment the opportunity to mature and potentially realize its long-term value proposition. Let's put this into perspective. If you're 30 years old and planning to retire at 65, you have a 35-year investment window. This extensive period is significant because it's long enough to encompass multiple Bitcoin market cycles. These cycles, which have historically occurred every 4 years and are tied to an event known as the halving, involve periods of rapid price appreciation followed by significant corrections. A 35-year horizon means you're not just betting on the outcome of the current cycle, but you have the potential to benefit from 8 or more of these cycles, allowing the long-term growth trend to hopefully overpower short-term downturns. Historical data, while not a guarantee of future performance, provides a compelling illustration. Looking at data since 2013, we can see a clear pattern. Despite dramatic crashes, every previous all-time high has eventually been surpassed. For instance, an investor who bought Bitcoin at its peak in late 2017 would have seen their investment decline by over 80%, but holding on through the subsequent cycle would have resulted in substantial gains. Similarly, even buying at the 2021 all-time high and holding through the subsequent bear market would have resulted in positive returns by early 2024. This resilience through cycles is a cornerstone of the long-term investment thesis. Beyond price cycles, the case for crypto is also a case for technology adoption. Many analysts view digital assets as being in the early stages of an S-curve adoption cycle, similar to the internet in the late 1990s or smartphones in the late 2000s. At first, the technology is niche and understood by few, but as infrastructure is built and use cases become clearer, adoption can accelerate exponentially. If this parallel holds true, an investment today could be analogous to investing in the internet's foundational protocols before it became an indispensable part of daily life. The potential for network effects to drive value over the next 1 to 2 decades is a significant part of the argument. Another core tenet is scarcity. Bitcoin's protocol dictates that there will only ever be 21 million coins. This fixed supply is unchangeable, standing in stark contrast to traditional fiat currencies, which can be printed by central banks at will, potentially leading to inflation and the erosion of purchasing power over time. Over a multi-decade retirement horizon, the ability to hold an asset with provable, programmatic scarcity is a powerful proposition. It's why Bitcoin is often referred to as digital gold, a potential hedge against inflation and a store of value for the digital age. Finally, it's crucial to view crypto's role through the lens of portfolio construction. For most, it's not about replacing stocks and bonds, but about adding a unique ingredient. This is where the concept of an asymmetric bet comes in. With a small allocation, say 1 to 5% of your total portfolio, your potential loss is capped at that small amount. However, because of crypto's historical volatility and growth potential, the upside isn't similarly capped. A small calculated allocation has the potential to disproportionately improve your portfolio's overall long-term return, acting as a powerful growth accelerant without exposing your entire nest egg to undue risk. The longer your horizon, the more time this asymmetric bet has to potentially play out in your favor. Now, let's put on our skeptic's hat and build the case against including Bitcoin in a retirement portfolio. It's a crucial exercise in managing risk. At its core, a retirement account has one fundamental job: to be a reliable source of funds when you stop working. It needs to be there when you need it, without question. This principle of reliability is where the argument against a significant Bitcoin allocation begins. The primary and most cited risk is Bitcoin's staggering volatility. While investors in traditional markets might get nervous during a 20% bear market in stocks, the crypto world regularly experiences drawdowns of 30%, 50%, and even over 70%. These aren't just numbers on a screen. They represent a real and dramatic loss of purchasing power. This level of volatility is uncomfortable in a standard investment portfolio, but it can be utterly catastrophic in a retirement account due to something called sequence of returns risk. Imagine you retire and immediately need to start selling assets to cover your living expenses. If the market is down, you're forced to sell more shares or more Bitcoin at low prices to generate the cash you need. This permanently impairs your portfolio's ability to recover and grow, drastically increasing the odds you could run out of money. If your retirement coincides with one of Bitcoin's multi-year bear markets, you could see your nest egg decimated at the worst possible time, with no paycheck coming in to help you recover. Beyond market dynamics, there are significant external threats, starting with regulatory risk. The legal landscape for digital assets is still being built, and it's uncertain. A government could impose prohibitive taxes, restrict access, or even attempt an outright ban, which could severely impact Bitcoin's price and utility. We've seen crackdowns in countries like China and ongoing legal battles in the United States. This global uncertainty means a change in policy could fundamentally alter the investment thesis overnight. Then there's custody and technological risk. When you invest through an ETF, or most IRA providers, you don't actually hold the Bitcoin yourself. You're trusting a third-party custodian to secure it for you. This introduces counterparty risk. What if the custodian is hacked? What if the company goes bankrupt, as we've seen with major players like FTX and Celsius? While regulated ETFs offer more protections, the risk isn't zero. The technology itself, while robust, is not infallible and faces theoretical long-term threats from quantum computing. Considering these severe and multifaceted risks, our AI recommendation is firm. If you choose to include crypto, it must be treated as a small speculative slice of your retirement portfolio, not a core holding. For the vast majority of people, this means an allocation of 5% at the absolute maximum. This allows for potential upside while ensuring that even a worst-case scenario, a complete loss of that allocation, won't derail your entire retirement plan. The Bitcoin IRA option. Companies like iTrust Capital allow you to hold actual Bitcoin inside a tax-advantaged IRA account. This means your Bitcoin gains grow tax-free or tax-deferred. For serious long-term Bitcoin holders, the tax advantage is significant. AI assessment. The tax benefit is real and meaningful. The platform fees must be compared carefully to that benefit. We've covered a tremendous amount of ground today, from the fundamental case for and against crypto in a long-term portfolio, to the nitty-gritty details of allocation, security, and the critical differences between ETFs and a self-directed IRA. The goal was never to tell you to do, but to equip you with a robust framework for thinking clearly about this emerging asset class. It's about moving beyond the hype and headlines to make a sober, calculated decision that aligns with your personal financial goals, your timeline, and your tolerance for risk. The core takeaway is this: for the right person, a small disciplined allocation to an asset like Bitcoin, held within a tax-advantaged structure, can represent a powerful asymmetric bet on the future. It's not about chasing short-term gains, it's about strategically capturing potential long-term growth while legally minimizing or eliminating the tax drag that can erode your returns over decades. This is where the real power lies, in the patient, methodical application of a sound strategy. To make this tangible, I've partnered with iTrust Capital. You'll find a link in the description below. It leads directly to their Crypto IRA Calculator, a tool I highly recommend you explore. It cuts through the abstraction and shows you exactly what the potential tax benefit would be for your specific situation. You can input your own numbers and see how tax-deferred or tax-free growth could amplify your returns over time compared to a standard taxable account. It's the first practical step in turning theory into a concrete plan. This is genuinely one of the most underrated crypto strategies for regular people. While the world is distracted by daily price swings, the quiet, powerful work of compounding in a tax-sheltered account goes unnoticed. It's a strategy that rewards a long-term perspective and financial discipline, the very cornerstones of successful retirement planning. If you found this balanced discussion valuable, please subscribe to the channel and turn on notifications. We're dedicated to providing clear, in-depth analysis to help you navigate the complexities of modern investing. And finally, I'd love to hear from you. Drop a comment below and tell me, do you currently hold any crypto in a retirement account? Or is it something you're now considering after watching this? Your insights help shape our community and future content. Thanks for watching.